Stop. Before you hit buy on another stock, you need to hear this. Because right now, millions of people are gambling in the stock market, thinking they're investing. They're chasing hype, memes, and hot tips without even knowing what they're really buying. And the truth is, most of them are destined to lose money. But there's one man who has spent the last 6 decades beating the market, Warren Buffett. He took $100,000 and turned it into over $100 billion, not through day trading or guessing, but through a simple, patient strategy anyone can learn. Today, I'm going to share Buffett's step-by-step approach so you never waste another dollar chasing the next bubble. We'll cover the mindset shift that separates investors from gamblers, the exact metrics Buffett uses to find winning businesses, the emotional trap that destroys most portfolios, and a 5-step process for analyzing any stock. If you've ever lost money buying at the wrong time or sold too early out of fear, this could completely transform how you see the stock market. First, you have to treat stocks like small businesses. Imagine you're thinking about buying this coffee shop. Would you obsess over what other people think it's worth tomorrow? Or focus on how much money it actually makes? When Warren Buffett buys Apple stock, he doesn't see a ticker symbol. He sees a real business with products, employees, and profits. Most investors? They treat stocks like lottery tickets or sports bets. This single mindset shift separates investors from speculators. Why does this matter, you may ask? When you own a share of Coca-Cola, you literally own part of every Coke factory, part of every vending machine, even part of their secret formula. Your goal isn't to flip that share to someone else tomorrow for a quick profit. Your goal is to own a piece of a money-making machine for decades. Understanding that, it's time to learn about intrinsic value, the real price tag. Here's Buffett's first and most important question before buying anything. What is this business truly worth? This is called intrinsic value, the real fundamental worth of a company. If a company is worth $100, but the market is selling it for $50, that's a bargain. But if it's worth $100 and selling for $200, you're overpaying, and future returns will be terrible. Why most people fail? Most investors do the exact opposite. They buy because the price is going up. They sell because the price is going down. Remember GameStop and AMC in 2021? People rushed in, not because of the company's profits, but because the hype was irresistible. When the hype ended, prices crashed, and most people lost everything. When it comes to most companies, profit is king. The foundation of intrinsic value is profit, also known as earnings or net income. Here's a simple question. Would you buy a coffee shop that loses money every year? Of course not. Yet millions of people buy unprofitable companies because they're trendy. In 2019, Tesla was finally turning profitable. Buffett loves companies that consistently generate earnings. But many people jumped into Rivian, an electric vehicle company that was losing billions. The stock initially soared to $170, then collapsed to under $20 as reality set in. Profitability matters. It's proof that a company can survive without endlessly raising new money. One of Buffett's favorite quick tools is the P/E ratio, price to earnings. Think of it like a thermometer for stocks. It tells you how much you're paying for each dollar of profit. Let's break it down with a simple example. A coffee shop makes $10,000 profit per year. You pay $100,000 to own it. That's a P/E of 10, which equals roughly a 10% annual return.
Wow!
But if you get caught in hype and pay $300,000 for that same $10,000 profit, your return drops to 3.3%. In 2016, Apple was trading at a P/E of just 10. It was a steal. Buffett bought billions of dollars worth. Today, Nvidia trades at a P/E over 50. That doesn't make it bad, but it means you're paying a premium for growth and your future returns are riskier. Don't think of shares as symbols on a screen. Think of them as slices of real, tangible businesses. Segment 2. Behavioral Mastery. Meet Mr. Market. Benjamin Graham, often referred to as the father of value investing and mentor to Warren Buffett, taught a fascinating lesson in investing psychology. Imagine you own a business with a partner named Mr. Market. Every day he shows up at your door with an offer. I'll buy your share at this price, or I'll sell you my share at this price. The problem: some days he's wildly optimistic, offering crazy high prices because he believes the future is bright. Other days he's depressed, offering dirt-cheap prices because he thinks disaster is coming. Mr. Market is basically that one friend who's either on top of the world or spiraling into existential dread, with no middle ground. Here's Benjamin's wisdom. Mr. Market is your servant, not your guide. You don't have to answer the door every day. You simply wait until he offers a price far below intrinsic value, then calmly buy while everyone else is panicking. A historical example would be the 2008 financial crisis. In 2008, during the financial crisis, Mr. Market was in full panic mode. Shares of legendary companies like American Express and Coca-Cola were collapsing. Buffett didn't sell. He calmly bought more. Years later, those investments produced massive returns. Patience and emotional discipline are your greatest weapons. A more modern example would be the 2020 pandemic crash. In March 2020, COVID sent global markets into chaos. Mr. Market was terrified. Stocks like Disney and Microsoft were selling for absurdly low prices. Smart investors who understood intrinsic value bought during the panic. By late 2020, those same stocks had doubled.
Wow!
Behavioral studies show most investors buy high and sell low because they follow their emotions. Fear makes you sell at the bottom. Greed makes you buy at the top. Think about Dogecoin or meme stocks. People bought in because everyone else was, then dumped their holdings at a massive loss when hype faded. Now, let's go over a simple 5-step approach you can take to analyze a stock. Step 1. Understand the business. Buffett only invests in companies he fully understands. Ask yourself, what does this company actually do? How do they make money? Who are their competitors? If you can't explain it simply, you probably shouldn't invest. Buffett famously avoided tech stocks for decades because he didn't understand them well enough, until Apple, whose business model he could clearly see. Step 2. Look at consistent profits. Find companies with steady earnings growth over 5 to 10 years. Avoid businesses that swing wildly between profit and loss. Sites like Ticker and Morningstar show historical financials, 5 to 10 years, clearly, especially revenue, net income, EPS, and margins. Step 3. Check the P/E ratio. Compare the company's P/E ratio to its own historical average and industry peers. If it's much higher, you might be overpaying. The P/E ratio is a quick way to estimate whether a stock might be expensive or cheap. But Buffett doesn't stop there. He digs deeper by estimating the company's future cash flows, the actual money the business will generate over time, and then discounting those future dollars back to today's value. This process is called a discounted cash flow, or DCF. It's basically the gold standard for figuring out intrinsic value. DCF might sound complicated right now, but don't worry. In the next video, I will walk you through step by step how DCF works. Step 4. Calculate a margin of safety. Even if you estimate intrinsic value correctly, you could still be wrong. That's why Buffett demands a margin of safety, buying at a significant discount to intrinsic value. If you believe a company is worth $100 per share, you might only buy when it's $70 or below. That way, even if your estimate is slightly off, you're still protected. Step 5. Be patient. Great investing isn't about constant action. It's about waiting for the perfect pitch, then swinging hard when the opportunity comes. Warren Buffett famously once said, "The stock market is a device for transferring money from the impatient to the patient." Before you buy another stock, Remember Buffett's 2 timeless lessons. Think like a business owner. Focus on intrinsic value and profits, not hype. Master your emotions. Mr. Market is there to serve you, not guide you. The stock market is like a battlefield. Your biggest enemy isn't other traders or hedge funds. It's you and your own impulses. By following these principles, you'll stop gambling and start truly investing. And over time, that can build generational wealth. If you found this video valuable, hit the like button and subscribe for more timeless investing strategies. And remember Buffett's wisdom: the best investors aren't the smartest, they're the most patient.